All right. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and I am back. I'm not sure if everybody realized, but I've been kind of on this big trip. My wife and I have been kind of on the road. Did a trip to the Dominican Republic to check out some real estate investment opportunities down there, and we got some really, really amazing things happening. Went to Colombia for a little while, went to the Las Vegas, played in the main event at the World Series of Poker, along with a couple other events in the World Series. That was a lot of fun, but now I am back. We are here, back in my studio. This is actually my first full day back in the studio for the first time in like 2 months. And so all the content that I've been creating has been on the road, doing stuff of that nature. But today, you know, and getting back here, what I thought I wanted to do, what I guess I thought would be really fun is to kind of do a video going through comments, going through the comments that have been put on the channel, because in my travels, I've had a lot of periods of time where I haven't had the ability to connect a lot of times with the comments, and I really try to do my best to engage with every single comment that I possibly can on the channel. And I've noticed that there have been a couple comments that people have almost like called me out a little bit for not responding. So rather than just like taking a time to write up this big essay and respond to some of these comments, I thought it would be fun to hop on here and actually spend some time actually responding to these comments, engaging with people, kind of seeing what's going on here. And so what I'm gonna do is I'm gonna make sure I'm checking out the chat section here. So if you want to engage or have any comments, you have anything you want to say or include in this whole conversation, by all means, include it down here. But what I'm gonna do is I'm going to actually pull up my comment section. And let's see here. I gotta make sure. I'm gonna try to produce this show all on my own here and see how I do. I don't know if that's gonna work or not. I'm gonna do my best. But this is my comment section here. And this is basically what I see on the back end in the YouTube studio. And you can see I've responded to some, but I thought it would be really fun to kind of hop on here and just go through some of these comments and go through some of the questions or comments that people are making, because you know, I just feel like that would be adding a lot of value. And I think it would be also, hopefully you guys will realize that I take this very, very seriously when it comes to the comments on the channel. I really do my best to engage with every single comment I possibly can. So let's get into this. We'll start from the top and go from there. So Yona Tekenzo, whatever, said, everyone who complains had bad designed policies, LOL. So this is a video I did on the 4 lies that life insurance agents use to sell Index Universal Life. And this person is basically saying that everybody who complains about IULs really just had bad policy design. That is not the case at all. Unfortunately, policies are poor. You know, like I guess I'll say this, is that it's policy design accentuates a bad problem. IULs just inherently are flawed, and there's a lot of I've done a lot of videos on this, and you can check out the Index Universal Life training playlist. I've got one from before 2023, and then you can see there's an IUL training playlist for 2023, because I had so many videos on this playlist. I had to like kind of, with the new regulation update with the AG 49B coming out and kind of updating all the regulations, I figured it was a good time to kind of start a new playlist, because the playlist was getting too long, and that is what it is. So let's see here now. Let's go to the next one here. I want to just get in. I've heard different about IUL commissions. Okay, so I did a video on my thoughts about the World Financial Group. Is World Financial Group, WFG, a good fit for you? In there, I did some conversations about commissions of IUL and how people sell IUL, because it is a higher commission-based product. And so somebody, or at least that was a portion of the video that I commented on. And somebody said, I've heard different about IUL commissions on commissions on IULs. There is also a performance history chart over a 10-year span that makes IUL make sense to me. But if you're your own bank, can that not help you invest in real estate, etc.? All right, so that's the question or comment. Let me break this down a little bit. First and foremost, as I'm looking at this comment here, I've heard, and I'm looking up at my monitor up here to read the questions. I've heard different about commissions on IUL. So here's the bottom line. Think about this with Index Universal Life. IUL pays a higher percentage commission compared to whole life insurance. Now let me clarify that. Whole life insurance and Index Universal Life have the ability to increase and decrease commissions based on the design of the policy. So with whole life insurance, you have a base of the policy, the base coverage of the policy, which is basically the base insurance coverage. And the base is the equivalent of effectively where the insurance agent gets paid their commission. Now you could do base and then paid up additions. I've got a lot of videos on that. I'm not going to break that down in this video. But if somebody did like 40% base, and then 60% PUAs, paid up additions, the commission on each one of those is much different. And how you design that policy really varies based on the needs and the goals and the objectives of the individual who's getting the policy written on them. But that's important to understand that whole life, you have that flexibility. And you have a wide range of flexibility. You could do 10% base, 90% PUAs, 40%, 60%. Like you could do all the way pretty much to 100% base and no paid up additions, which I would never do. So that said, that's the whole life side. Now on the IUL side, there's target commission. The target funding of a policy is the equivalent of the base as far as, and what I mean by that, that is how the commission is paid to the agent. Now, on an IUL, yes, you can overfund it. They don't do it through paid up additions. They just do it through extra premium going in, and that premium goes more towards the financial efficiency of the policy itself, right? So it goes more towards a cash value. When I say financial efficiency, I'm talking about cash value growth. That's really ultimately what it comes down to. And so when we look at that and we say, all right, equal apples to apples, target versus base, that is the commission. The target commission on an IUL is much higher across the board than it is on the base of a whole life insurance policy. That is just the way it is. There's a lot of products, like I'll tell you right now, the Allianz Pro Plus has one of the highest commission rates that it's paying on the target premium. Now, both apples to apples, if you want to compare it whole life to IUL, you have to compare base commission rates to target commission rates. And then from there, you could say, all right, what does it look like for flexibility? Do we want to overfund the IUL? Do we want to add more PUAs to the whole life insurance policy? And now we could talk about how we're doing that and how we want to structure that. Now, it's when you look at it like that, that is how you compare the commissions from one product to another. And when we compare those things, apples to apples, IUL pays a much higher commission rate. Now, they also said that there's a 10-year history chart that has shown that they like the results of an IUL. But looking back, it's easy to show marketing on what the index has done, but the bottom line is the performance of the S&P 500 or the performance of any index really doesn't have that much to do with the success of the policy itself, which is totally against the grain of thought for what most people believe about how IUL works. Now, the bottom line is this is why I created the Index Universal Life Challenge, the IUL Challenge, because of the fact that even during the greatest bull run of all time, where the product is sold on upside potential and downside protection, they were not able to take advantage of the upside potential in the markets because they didn't even perform up to the illustrated expectations, which were quote unquote conservative, but then in the greatest bull run of all time didn't beat those conservative expectations. It's because the performance of the policy has nothing to do with how the S&P 500 index or whatever index it is performs. It has to do with what's the options budget and what are the options costs and how do those perform, because the options budget, the options costs lead to the costs and the pricing of the cap rates, the participation rates, the spread charges, anything of that, all the different variables inside of the policy that actually go to how the policy performs. And the reason I say the S&P, for instance, if you have the S&P 500 index, has nothing to do with how the policy performs is because that index performance is only as strong as what the cap rates, the par rates, and the spread charges are in that index. But those variables are all dictated and determined by the options cost and the options budget. And so that's all that matters, because if they change all those rates, the S&P 500 could have a huge year. Doesn't mean you're going to capture or capture any of those gains or participate in that success in the market. So I hope that makes sense. All right, so anybody has any questions? Hey, what's up, Andre? What's going on, man? So anybody has any questions about that, feel free. If you want to keep, if I'm saying anything, I guess I should say that makes you have any questions, feel free to chime in. I'll do my best to also respond. Go from there. So somebody says you make videos because you definitely sell whole life insurance and that's why you don't like IUL. Yeah, I mean, so funny thing about this guy, Doug Andrew Exposed. When I made this Doug Andrew video, I actually didn't sell whole life insurance. I was actually not licensed to sell at all. I was just at that point just making videos to educate people and to help people, just have a better understanding. I guess that's a good thing to, I guess, transition to here, is just to kind of share my story a little bit. For everybody who doesn't know, I got into the business in 2009. I was a really big advocate for IUL. I sold IULs for 4.5 years. I was the director of business development for one of the top IUL companies in the country. And then the deeper I got, the more success I had, the more I realized like these IULs are not what they are being pitched as. They're not what they're being positioned as and being sold as. And so I just, in full integrity, couldn't get behind it. So I had to move on. And I didn't transition immediately to whole life. I just transitioned away from like selling IUL to really questioning everything I thought to be true. And then in my process of trying to research and discover, I realized whole life insurance was in fact, what I was looking to help people utilize as a product to accomplish their goals. And so when I left, I got involved in a lawsuit with the company. It was a non-compete lawsuit. I won the lawsuit. There was some things that happened. I got hit with another notice, and basically I was told by my attorney that if I wanted to keep making videos to educate people about this, I had basically this period of time that I couldn't talk, that I had to keep my mouth shut about everything that was happening. And so I decided I had to make a choice. I either had to give up my license and keep making videos, or keep my license and sell and not make videos. So I decided to give up my license, make videos, start a marketing agency, do videos on the side to be able to help people. And that's what I did. I started helping agents build their business online. I started working in other industries, helping people with online marketing, sales funnel development. I became a partner with ClickFunnels, did a bunch of stuff like that. We launched a marketing agency and had a lot of success. COVID came around, and if you go back and look at the channel and you watch the videos and you look at the dates on them, you'll see that there's a big transition. I've gone through different content because I've always done videos on life insurance and financial education and all this stuff. But at the end of the day, I also had a period of time where you'll notice there was a lot of conversation about marketing. I would do videos on different marketing strategies and whatever. That's because I was running a marketing agency. Then what happened while I was doing all that at the same time, COVID happened. All my marketing business got shut down, and so I decided to get full-fledged back into the life insurance space. And it wasn't until the very beginning here at 2023 that I actually got my license again, so I could actually sell. So a lot of people that look and they want to criticize me for the Doug Andrews comments and like saying all the content that I made was just to sell whole life insurance. I haven't been able to sell. I created videos just to educate people and serve and help people for literally like 6 years without the ability to sell. And the only reason I started the IMO and the only reason we started the agency the way that we are, to help people, to help agents be able to connect with people and learn how to sell better, more effectively, and communicate the value of what life insurance can be in people's lives in the way that we position it for. The only reason I did that is based on demand, based on the fact that there was nobody else in the industry that was out there doing what we're doing. And so that is the real reason that, I decided to kind of get back full-fledged into this. And then, the deeper I got, it just made more sense for me to get my license and to be able to help people, because I wasn't able to show up and do things the way that I wanted to, without being licensed. And so it was just a little restrictive without having my license. And, that is what it is. So Jeffrey Kamke, made a comment here, said, we had a high up in Young Living essential oils come to us after blowing over $30,000 on an IUL based on the amazing returns promised, because it blew up and was going to cost $12K to reinstate. after the internal fees. Completely insane. This is once again on that 4 lies used to sell Index Universal Life. Now, the crazy part here is I have a very, very similar story, but it's a way worse story at this point in time. We're actually working with somebody right now that put $1.5 million into an IUL. We're going to be doing more with this person, I think, as time goes on. But they put $1.5 million into an IUL, and they've lost over 200, I think it was like over 20% of not just what they put in, but what the illustration said it would have. And we're only 5 years into this policy, actually 4 years into this policy. They're already behind where the illustration conservatively said it would be by over 20%. They've lost over 200 something thousand dollars in this policy. So these are the things that I see all the time when people are like, Chris, why are you so passionate against this? Is because, and why, I guess, why are you so passionate against IUL, and why do you spend so much of your time creating anti-IUL content? I would say that I don't create anti-IUL content. I create educational content that is designed to get people to understand IUL better. Now, am I anti-IUL? Yes, I am. And the only reason I'm anti-IUL is because I think it's dangerous. I think it's misrepresented. I think it's going to have a backlash. The fallout from IUL is going to have a negative impact on the whole life industry. It's going to have a negative ripple effect on everybody that's trying to do the business the right way. My real focus, and this works, and I know I've been successful, and that's why I double down on it. My real focus is to educate people. I know, like, I have no judgment for people that are selling IUL, because I believe that the problem isn't the agents, the problem is the companies, the carriers that are actually manufacturing and creating these products and then training their agents on it. I worked inside the belly of the beast, if you will, in that sense. I believed everything I was taught, and it wasn't until, remember, I sold, let me say this, I sold for 4.5 years before I realized and came to a conclusion like, wow, this isn't what I thought it was. So I had to make a difference. I had to change what I was doing. So I don't judge anybody for buying the story, for believing and going out and doing it. And so that's not the problem. My problem is with the companies, not the agents. A lot of people say that the agents are the problem. No, the companies are the problem. The agents are just doing what they're taught, and they're taught by the companies. And if you're taught by the companies, you're only getting a fraction of the information you actually need to be able to serve people the way that you're probably looking to as an agent to serve. So what I do on this channel is I just try to create educational content that really explains how IUL truly works, not what it's being sold as, not just focused on all the hype and all the upside, not focusing on any of the negatives, any of the downside, any of the restrictions, any of the fact that you give up a lot of control. That the companies don't focus on that. If you think about it and you use common sense, you realize that insurance companies created UL and created IUL. Well, IUL is just an evolution, I guess, of UL, in the sense that it's just using an option strategy on a UL platform. That's it. It's nothing more complicated than that. And so when you look at that, the UL chassis itself, the platform of UL, is just simply designed to shift the risk from the insurance company to the insured, to the policyholder. That's it. And so you can't expect to have all the benefits of what whole life brings to the table and have all the risk on you at the same time. To me, when I look at what's the number one attribute of any asset that successful people want to put their money in, it's control. And when you put your money in an IUL, you give up control, because the whole life or the life insurance company, the IUL company, has the ability to transition or change any of the variables in that policy to their benefit and against the benefit of the policyholder. And for those who say, oh, well, a life insurance company wouldn't do that, I encourage you to go back and look at the results from, let's call it 1990 to 2005, and look how UL companies treated all the UL policyholders that had their policies lapsing. See how they treated them then. And when they say, a life insurance company would never do that to a policyholder, just go look back at history and see how they treated them. And if you're like me, history has a habit of repeating itself. And to me, that is just what happened there, we're gonna see happen again. And remember, IUL, I call it just a failed financial experiment. We're looking at it. It's been worse and worse and worse results every single year since it was instituted in 1997. And I think time is gonna tell the truth about it all. All right, so we got a Let's see what we got for comments here. I got a couple things here. Thanks for all your content, Chris. Yeah, you got it, Larry. Thank you. I love doing this. So Matt Elin said, I think IULs can be poorly designed, similar to whole life, along with needing to be careful with the company chosen, also similar to whole life. Just a thought. Yeah, so Matt, I would say this. I would say that IUL is across the board. I would say whole life and IUL, both of them you have to worry about policy design. There's no doubt about that. I would say even with a quote unquote good policy design with IUL, highly overfunded, maximum cash value, minimum death benefit kind of design, what a lot of agents would do, option B, while they're funding it, and when they stop funding it and retire and want to take income, they go to option A, which is a level. That kind of design that people are talking about, I would say even with that, there's a ton of risk in IUL that people do not realize that they're taking on. That, to me, is the biggest problem of IUL, is how it's sold. People are sold on upside potential, downside protection. You can't lose money to market risk. And the bottom line is nothing could be further from the truth. When you're accumulating money in an IUL, okay, if you buy it when you're 30 and you're looking to accumulate, well, guess what? Any negative years, if you don't have any policy loans and there's negative years in the market, the cost of insurance is low, all these things, you're not gonna have a problem. But the bottom line is my biggest challenge with IUL is that it's sold for tax-free retirement income most of the time. It's sold as an alternative to a 401k. That's how it's sold. That's how MPI sells it. That's how all the WFG people are selling it. That's how PHP people are selling it. That's how all these people, Doug Andrew, that's how all these people are doing it. And the bottom line is when you look at this, I don't care about how it functions while I'm accumulating. I care about how the IUL functions while we're in the distribution phase, while we're thinking about taking income in retirement, because that's why you're buying it. And if it doesn't work well for the intended use and purpose, and if it creates more risk in that environment, therein lies the problem. Here, my philosophy is you should never utilize any life insurance product as a primary source of income in retirement, period. Whole life insurance can be a great asset as a volatility buffer, as like a bond alternative, as part of a bigger financial strategy. Whole life insurance is a great banking alternative. Whole life insurance can be a great way to finance real estate transactions and purchases. But the bottom line is when everybody says that IUL is a great 401k alternative, it's a more efficient way to do it, it's not. And I've done videos recently that have gone through and that have shown that, yeah, they say you can't lose money due to market loss. But the bottom line is if you're in retirement and you have policy loans out and you've used index loans, which is what all these companies do, and which almost all the agents do to illustrate higher returns because they want to build in that positive arbitrage on the illustration, right? And so if you do that and then you get to retirement and you've taken a loan out, and I showed this one example of this one illustration that I showed that showed this guy having this massive income coming from this policy, but it always shows positive years on the illustration. That's a challenge. And what I showed is when you get 75 or 70 even, and the cost of insurance goes up, and you have a lot of policy loans out, and then you have a negative year, you have to cover that interest expense. And that interest expense gets taken out of the policy. And then you have, because that interest expense comes out of the policy, now you have an increase in the net amount at risk. And it may not seem like a lot because it doesn't illustrate it, but when you increase that net amount at risk on the illustration, or in real life that's not able to be shown on the illustration, that increases your insurance charges and all the fees inside of the policy. And so I literally showed how every agent that sells IUL goes, oh, it's gonna take like 8 years of negative in a row for these things to blow up. But that all changes as soon as you take policy loans and as soon as you're in retirement, when you know you're gonna be taking policy loans every year and you know you're not gonna be paying them back, and that's just part of the strategy and the design of these things. Well, in retirement, these things blow up really, really quickly. And if they blow up before you're 79 and a half, when the overloan protection rider kicks in, now you're in a situation where not only does a policy blow up, not only do you not have the money for retirement, but now you're also saddled with potentially a massive tax liability, and that is the problem. So anyway, that is my thought on that. Do I use convertible term in my design? So we utilize convertible term a lot. In a lot of situations, we utilize convertible term. I'm a big believer in convertible term because I think the insurance, well, let me say this. My belief on the importance of convertible term has changed a lot over the years. I share the story in some of my videos of my best friend, 51 years old. He died of a heart infection. I was not really big on selling the insurance part. My whole career at the beginning, as I started in the life insurance space, I really focused on the cash value element of things. Like I said, I got in because of the IUL. And then even when I realized IUL wasn't something I was comfortable selling anymore because of what I realized, and I transitioned to whole life, I did everything through the lens of just cash value, banking alternatives, utilizing it for real estate investments. The liquidity of the policies is all I really focused on. I looked at the life insurance component as kind of like this ancillary benefit that nobody really cared about, or I didn't care about it so much and whatever. And my perspective on that has changed immensely over the past, say, 5-6 years. And I'll say this: in 2019, I had my best friend die, and he died of this, at 51 years old, of this kind of random acute heart infection that we had no idea was going on. He ended up in the hospital, and it's a long story. But the bottom line is, I didn't push the life insurance on him, and then after that, his wife and his daughter, who was in college at the time, they were left in pretty rough situation comparatively than they should have been. And I took a lot of that responsibility on for not pushing the life insurance side harder. It made me realize how important this is, because when something like that strikes you so close to home, man, it can get you. And then the other thing that happened for me was the living benefits that I knew the value of them, but it never, none of this matters until it really touches you close to home. And in 2020, November 4th, 2020, my father-in-law was diagnosed with pancreatic cancer, stage 4 pancreatic cancer. They gave him 90 days to live. The oncologist said there was nothing they could do for him, basically. And because of the fact that, you can tap into the living benefits of these things and access it, to be able to utilize cash, to be able to pay for alternative medical treatments. I'll tell you this: my father-in-law is still alive and playing golf 4 days a week with pancreatic cancer, simply because he had access to the capital to be able to treat it in a way that most people are not able to treat that cancer. And if you know nothing about pancreatic cancer, there is not many other cancers in the world that are more of a death sentence than pancreatic cancer. And so to be able to do this, it is it's unbelievable. I have no words. It's hard for me to talk about this without tearing up and breaking down a little bit, especially these are two of the most important people in my life that have been in my life. My father-in-law has been really impactful in my life, because it's funny, my father-in-law is a former financial advisor. He worked with Wells Fargo and Wachovia and A.G. Edwards and all that. He was a traditional wirehouse broker. I got into this business initially, into the insurance business, thinking I was going to take over his business. And I started to learn real quick. I walked away from taking over his book of business and having a guaranteed, pretty good lined up income, because I didn't believe in it. And that's just my mindset. And you'll learn that about me if you haven't yet. If I don't believe in it, I can't do it. And so, anyway, I over the years, I've really transitioned. And what I will say, just to kind of come circle back around and answer the question more succinctly, is I believe in convertible term insurance. I think we need to start with the insurability need. And I think from that perspective, utilizing a company, not getting the cheapest of cheap term, but getting convertible term with a good company that not only is convertible, but convertible to a good product, convertible to a good whole life policy with a participating mutually held company, and making sure that those policies can convert to banking style policies if that's what you want to do. That will lock in your insurability. It will make sure that as you handle paying off debt, getting the rest of your financial house in order, you have the insurance protection in place. And then as things improve, as cash flow improves, as you want, as you deem it appropriate for your own situation, and as you work with your advisor, coach, agent, whatever you want to call it, you can figure out how to implement a strategy on conversion of that policy to a cash value policy that will accomplish all the other things that we talked about in the videos. So that is that. Awesome. Rock and roll. So, all right, Sean Gavin. All right, Waka Flocka Flame, the rapper, got screwed over by having an IUL policy instead of having a properly designed whole life policy. You know what? That is one of the saddest stories that I can hear of. And this is a classic example of what I'm talking about. I'm guilty of this, right? Like, I took the Waka Flocka video and I made some marketing content and I did it on TikTok and I did it, and that was like honestly one of my top videos that I made at the time. And so from that perspective, like, I mean, I'm glad I got some exposure, but the downside of that is like, you realize like people like him, and I didn't realize it was an IUL that he'd done at the time. I just did this video like all other agents. I was like, it's an opportunity to create some content. And this guy obviously really likes what he's doing. But the more that time went by and the more I kind of looked into it, the more I realized like, oh my gosh, this guy actually got screwed over. And the reason is because, you know, it was an IUL and he didn't have the liquidity. All the things that could have been true if he had a properly designed whole life insurance policy, the facts and the whole design and everything gets manipulated. And now you went from having a complete advocate for the industry to now somebody who's successful, who's got influence, who's got a lot of leverage, quite frankly, who can, you know, cause a lot of problems, quite frankly, for this industry, you know, and it's those bad policy designs that are going to have a fallout effect. A lot of people don't realize this, but like I've done a lot of evaluations. We've worked with several NFL players that have been in bad IUL policy designs that we've helped them, you know, get their money back and, you know, just figure out how to go through a process to really get out of these poorly designed policies that were designed. They look really good on paper, but then they don't ever fully execute the way that they're illustrated. And when you're talking about these policies that are hundreds of thousands of dollars a year in premium, the consequences are crazy. And for these people that are buying these policies designed for security, right? Quote, like in their mind, they're buying them because of the security that they're being sold as. You can't lose money due to market loss, upside potential, downside protection. It's all like it's all a marketing game. It's all just smoke and mirrors with IUL and never performs that way, and that is the problem. So, all right, let's go here. 100, yeah, thank you, FCAT. Proud of you, brother, for making the changes. Thanks, man. Thanks, Andre. Matt Allen, thanks. In contract, most whole life will wash interest in the distribution years. Is that primary correct? So whole life insurance for distribution years, I would say it depends on the interest rate environment, honestly. You know, we've come through this long-term declining interest rate environment. And so remember, it's important to understand, actually, you know what I'm gonna do? Let me go here. Let me just pull this up. I'm gonna do something here. Let me, bang. Hold on one second. And I'll pull this up and I'll be able to do something. All right, so what I want to do is I'll do this. Let me see if this works. Hopefully this will work. All right, so what I want to show here is like, this is important to understand. Let me just make sure it's working. I got a little delay on the, little delay here, but we're good. Okay, so I think it's working. So what we have here is, if we look at the interest rate environment, right? We have like 1979. I've done some videos on this before, but I'll show here a little bit. 1979 interest rates were at 20%, okay? So the federal funds rate, when I say federal interest rates, I mean the federal funds rate. So the federal funds rate was at 20%. So from 1979 to like, obviously this isn't to scale, but 2009, interest rates went down to zero, okay? And then from 2009 to 2020, basically, interest rates were at zero. So we had this long-term time frame right here. Lowest interest rate environment was 0% interest rates, basically. They did fluctuate a little up and down there, but now in 2022 or 2023, interest rates have gone back up to about 5%. Now, why am I showing you this? Because the answer to your question really is dictated based on our interest rate environment, because it's important to understand, and I'm going to just do a different color here for the dividend rates. So the white scale here, I'll just do white equals Fed funds rate. And the green will equal dividend rates with whole life, okay? So think about it this way. In 1979, I think one of the important things to do is understand is before they got hiked up, they were at 6%, okay? And they got jacked up to that point in time. Now, at that point in time, what happens is there's always a crossover. Because the dividend rates were also around, let's just call it 6%. But then what happens is as rates go up, dividend rates will chase the rates. They're going to be lower, but they're going to chase the rates, and then they're going to go up. And what happens is, as they're going up, when rates are going up, dividend rates are going to be lower than the federal funds rate, and they're going to chase the rates up. I always kind of say dividend rates are always chasing whatever the rates are in the market, okay? And so then there comes this inflection point, this crossover point. And so for the last 40 years, and this is why everybody loves non-direct recognition companies, because of the fact that this exists, right? And the fact over the past 40 years, we've had this environment where, yeah, non-direct recognition has been better. And I'm not saying it's going to be worse. I'm just saying you have to understand how these things work. We've had rates, dividend rates, chase the rates down. So what does that mean? And that means there's always this gap, or has been this gap for this period of time, where dividend rates have typically been higher than the federal funds rate. And then it came down when federal funds rate was zero, and loan cost of borrowing, this is where cash value lines of credit became so popular, is because during this period of time, dividend rates were higher. You know, we'll call it, say, 5 to 6%. Right here, then the 0% cost of money for the federal funds rate, you could get a cash value line of credit for 2.5%, and you could build in this positive arbitrage right here in this space, and that was like free money, right? That environment, it's using this tool how to create that positive arbitrage. But the problem is this, is now dividend rates, what's happening is interest rates are going up, and they're at 5%, but now the dividend rates are kind of dropping off because it's been this low interest rate environment. This whole period has been stressful for the insurance companies. This is why they created Section 7702 to allow guarantees to be dropped from 4% down to 2% to 3.75%. That's what it's all about. That's what Section 7702 is designed to do, is because, or it was created because of the stress that this environment put on the general funds of the insurance companies. Now, dividend rates have gone down a little bit. And this is obviously not to scale, it's just to conceptualize, okay? And now what's happening, as interest rates go up right here, and let's say they get up to 8%, hypothetically. Now we're gonna have, these rates are gonna chase, and there's gonna be a negative arbitrage for a period of time, okay? And it's just important to see how this works, right? And the good news about whole life insurance is, if you go, the max cap that you're going to have on a loan rate for whole life insurance is that 8% number. So if the federal funds rate does what it did, back in the day, and goes up to a higher rate, which I don't think it will, because that's just way out of control. But even if it hits 10% or so, the cost of borrowing and the leverage, the benefit of a whole life insurance policy and access to that capital, that benefit is still going to exist. It's all about the strategy in how you plan on utilizing it and leveraging it and getting there, right? So, so hopefully that makes sense. I'm not sure. Feel free to dive deeper if you have any more questions on that, and I'm happy to kind of get deeper into that if you want. But let me see here. I'm going to try to catch up here. Agree totally. So I'm saying a poorly designed IUL, is there any way for a good designed IUL? No, that's what I was saying, is like IULs, there's no real good way to design an IUL, because it's not about the design of the IUL. It's about the features of the IUL. That's the problem. If you think about it, what are all the things? Okay, I'm going to go over here again. I love having the whiteboard here. So if you think about it, So with an IUL, what are we doing? What are the features? What are we looking for with a whole life insurance policy? I think it's important to look at, why do I want the life insurance product in general? I want it because I want the guarantees, I want the liquidity, I want the control. Well, with an IUL, guarantees, right? What are they? They're garbage, right? Liquidity. Can you make an IUL with good liquidity? You can make some better than others, and that's where policy design would come in, for sure. But for the most part, because of surrender charges, the liquidity is not as good as whole life, right? So can you have better liquidity in some IULs than others? Yes, I'm not going to say you don't have any, but it's very hard to get an IUL to have the liquidity, especially early in the policy, that a whole life policy has, which if you're looking at it as a banking alternative is really important. Now, when we look at the control, that's the biggest difference. I use this in analogy in a speech I just gave at Caleb Williams and Asset Mastermind, and I talked about the fact that the biggest thing that we talk about when we, well, I guess let me slow down here for a second because I get excited about this. If I gave you two options and I said, hey, we're going to start a business, and you knew you wanted to start this business and you wanted to invest in a business and you had money to invest in a business and you wanted to go forward with this business, but you had two options of business partners to choose from. And you said, all right, option one, the business has a little bit more upside, but the history of the business partner that you're looking to get involved with has a very bad track record of meeting their promises, of being successful in business. And at the same time, at getting involved in that business partner, they say, by the way, as soon as you sign the contract with me, sign on the dotted line with me, as soon as you do that, we're going to be in a situation where you have no control over the variables of this business. You're going to have no input. I'm going to be able to dictate and change all the terms on all the cash flow and all the investments and all the way that this thing actually needs to perform to be successful. You're going to have to put your full faith and trust in me, the business owner, your partner, in this. And I have the ability to change everything to my benefit and not yours. On the other hand, you have another opportunity to get involved with the business partner. And that business partner goes to you and says, hey, listen, I've got 180 years of success, not as much upside on paper, but I promise you, whatever you do with me, I'm gonna like, as soon as we sat on the dotted line, my only responsibility is gonna be to make this business whole and to make sure that you get your returns, to meet the guarantees, and to make sure that you're made as liquid and solvent, and you're, this is all designed for you to have as much control of this policy. And as soon as you sign on the dotted line, all the responsibility and obligation is on me meeting those objectives for you. Whereas the other business partner, it's as soon as you sign on the dotted line, you have to keep funding it, and the business partner can put all the obligation on you to keep that policy going. That is the biggest difference. And if you look at it from a business term, there's not an entrepreneur in the world that's going to look at those two terms and choose this business partner. But when people choose IUL, that's exactly what they're doing. And it makes no sense. Anyway, that's I think that's important to understand. And the reason I bring that up is because it all comes down to this, and that is control. And control is the number one attribute that people are looking for. And when in IUL, the reason I don't like IULs is because the guarantees are not as good as whole life. A lot of people say, I don't care. Okay, if the guarantees aren't what matter, the liquidity's not as good, apples to apples, as whole life. And the control in an IUL, you're giving up virtually all control, whereas in whole life, the only variable that you have to meeting your responsibilities is you paying your premium payments. As soon as you do that, as long as you have the right design policy, apples to apples, you are in complete control as the policy holder. And so to me, that's where the rubber hits the road. So anyway, yeah, Dave. So hopefully that answers your question on that. That's why I just don't believe there is a good IUL. I think the reason I'm so passionate for creating the content that I do, both for whole life and against IUL, it all comes down to the fact that I think it's really important that people understand what they're getting involved with. And it's not that IUL is bad, it's that IUL is certainly not what people think it is. And that makes it not a bad product, but it makes it a bad fit for most of the people that are purchasing it, if that makes sense. And I think because there's so many people with a bad fit, it has the potential to cause a lot of harm to the industry, to regulation, to all these different things that I think are coming down the pipeline. And that alone, I think, is I think it's important for people to understand that and kind of go from there. So, tell you what, guys, that I didn't get to all the comments, all the questions, but I got to a lot of it. I do. This ended up going a little longer than I thought it would go, for now at least. But what I'm going to do is I'm going to I'm going to stop this broadcast now, but I'm also going to come back and I'm going to do this again over the weekend here. I'm going to go live one more time this weekend and get more to the comments. And I'm going to keep doing these to catch up and go live. So if you have any questions, any comments, go through the videos, make comments, do all that stuff. And I will do my best to engage with every single one. And I'm going to try every single week now to not only respond to the comments via text and responding that way, but I'm also gonna do it in this video format because I just think it's way more impactful. I can go much more into depth and answer questions much more transparently in a video platform using the board, really educating, because I think it's important that people understand this stuff really, really deeply from there. So hopefully you found value in this. Yeah, friends don't sell friends in IUL. That's a good one. Yeah, so hopefully you guys found value in this. If you did, please like it, share it, subscribe if you haven't already. You know, all those things, get it out there to people. I think this stuff is really important. I'm excited to be home. It's my first time in the studio in like 2 months, so I'm excited to be back and look forward to helping you guys. And if anybody has any questions anytime, go ahead, email chris@life180.com. I'm happy to respond, happy to help, whether you're an agent, whether you're looking to get a policy, whether you're needing a review for a policy, anything of that nature. If you have an IUL that you own that you're looking to get a review of, we do a lot of that and we can give you a lot of clarity about what your situation looks like. And that's it. So that is it for now. Have a blessed, inspirational day, guys. We will talk soon. Take care.